Well, again, thank you everyone for joining us on this morning. We appreciate you taking time out of your day. We hope this will be an informative and beneficial presentation. I know for myself, I felt like I needed to find a beret and kind of disguise myself as Jamie from Mythbusters, as there's a lot of misinformation perceptions around fiduciary insurance, Fidelity Bonds, and cybersecurity information. Just a quick housekeeping before we dive in. We will be recording today's session, and we'll be sending out a recording. The mics are on mute, but we will open it up the chat feature for Q&A. The discussion will take about 20, maybe 25 minutes, so we'll be leaving some time, obviously, for Q&A after that. Quick word about Fiduciary Pension Partners. We are an independent registered investment advisory, really focused on retirement plans. We work with maybe 100 or so plan sponsors across the country with about 1.9 billion in assets. And you can see on the screen where we specialize and where our expertise lies. In the plan design aspect of it, bold plan design, that we're able to provide so that folks can optimize key stakeholders, optimize their benefits, as well as employees take advantage of the defined contribution or retirement plans. We provide the investment analysis, both from a implementation as well as an ongoing and monitoring perspective. We work as your advocate from the plan sponsor perspective, helping with the various vendors that are going to be involved with your retirement plan or plans. We offer a fiduciary briefcase and plan governance where those meeting minutes are memorialized. And we are also involved in the employee education, making sure your employees understand their retirement benefits, how those might be harmonized so that they can optimize those. And then before I turn it over to Michael for an introduction, I'm also very proud to share that the National Association of Plan Advisors for the 5th year in a row has recognized Fiduciary Pension Partners as a top defined contribution advisory firm. We couldn't have done that without the team, our clients, or tremendous partners like Colonial Surety. So let me turn it over to Michael to talk about the value and services that Colonial.
Thanks, John. So just to give a rundown about Colonial Surety Company. So I'm the business development manager for the company, also the ERISA department manager. We're a direct insurance company and a leading provider of pension professional and plan sponsor insurance in the pension industry. We don't use any agents or brokers and are the direct writer of the policies that we issue. So once an application is completed online, policies are available instantly as a PDF document. As per the list shown right here, we're incorporated in 1930. We're Treasury listed, licensed and admitted in all the United States and its territories, and rated A excellent by AM Best Company. We're also on a list of Department of Labor approved surety companies.
Thank you for that, Michael. And let's now,
of course,
if I can get this, there we go. For today's agenda, we'll talk about the ERISA Fidelity Bond and tap into Michael's expertise regarding that. Fiduciary liability insurance, we've got some real life case studies to share. The cyber liability insurance, that's getting a lot of discussion and play. And then, of course, we'll wrap it up with the Q&A. So all of this stems from the ERISA Act, right? That 5-letter word from 1974, and all plans have to have an ERISA Fidelity Bond. So, Michael, if you could provide some details as to what that is and the protection that that offers.
Sure. So the ERISA Fidelity Bond actually protects plan participants from internal theft in assets. That's the easiest way to put it. The way that it's discussed in the ERISA Act is defines it as losses sustained due to acts of dishonesty or fraud by individuals that come into direct contact with or exercise discretion over plan assets. Where the bonding requirements come in, if you have more than one participant in a retirement plan, for qualified assets such as stocks, bonds, and mutual funds, you're required to have a bond covering 10% of the assets. but plans that have more than 5% in non-qualified assets like real estate, precious gems, anything tangible would have to have a bond covering 100% of those assets. Not having an ERISA Fidelity bond in place puts you at risk really of an audit and possible citations. Not only that, but of course you're not protecting your plan participants in case something were to happen. And when it comes down to the actual advantages of having the ERISA Fidelity bond through Colonial, our ERISA Fidelity bond is actually Department of Labor approved. So you know that you're getting the correct policy for exactly what they're looking for, and it's written to protect the plan participants from internal theft and assets, and it references the legal plan name. So those are all things you have to monitor if you're not, of course, bonding through us. You have to make sure that the policy is written correctly so that it doesn't get pushed back by the Department of Labor.
Great information. Thank you for sharing that.
Of course.
There we go. Now, what we've got on the screen is, Michael, is a letter from the Department of Labor, and that doesn't look like something anybody would want to get. So maybe if you could kind of walk through the why and what this really means.
Sure. So as you can see with this letter, it's a little older, but it shows you that a plan sponsor received this letter, and the DOL was actually auditing plans back to 2013, which means they were going 5 years back and just looking at Form 5500s and basically looking to see if that box was checked off, that there was an ERISA Fidelity bond in place, and if it was for the proper amount. They're looking for that 10% bond. Occasionally, if you're really, really over bonding, they're asking like, why are you doing this? What are you trying to compensate for? But the whole piece of this, like I said, there's not really any fines that are associated directly from the ERISA Fidelity bond right away. For that, most of the time it's just go out, get this bond, get it in place. But technically, once the funds are first put into the plan, when you do have another participant, not just one participant, but multiple participants actually contributing to the plan, that's when the bond should have been in place. So it's another positive note that Colonial is one of the only companies out there that actually will write retroactive coverage. So if you weren't aware of this, if you weren't educated on this, your third-party administrator may not have told you up front, which most of them will, then we can actually write retroactive bonds. They go back in yearly increments, as long as you're purchasing at least a year forward with us. And they're dated from the date of purchase, of course. So we have gotten a lot of plan sponsors out of sticky situations when it comes to that, where the DOL has come and said, hey, you haven't had this for 5 years or 10 years or whatever have you, and we actually do write that for you.
That's important, that retroactive piece of it. But that's where firms like Fiduciary Pension Partners, where we work with Colonial Surety as well as the plan sponsor and the vendors, right? That's part of the vendor management that we do. Now let's take a look at some real life examples. So Michael, the first one, a bookkeeper writing bad checks. How does that happen? How does the bond play into that?
Sure. I mean, so the bookkeeper, of course, has access to the checkbook. And if the bookkeeper decides to, say, write a check for herself and cashes it in hopes that nobody notices, then nobody really notices for 2 years. I mean, that lesson would be that the plan sponsor needs to monitor those account statements that are going through, double check to make sure that payments are going out of the account, that they're legitimate. Bonds have loss and sustained discovery periods, so you may only be covered for losses that take place and are discovered within the bond term or a set period of time, and it's usually about a year afterwards.
And then the next example is theft of employee deferrals. And obviously, you always want to verify that deposits have been made. And there are ways to do that, right, through the plan sponsor portals. But maybe spend a couple of minutes talking about that.
Sure. So Of course, HR personnel is responsible for effecting transactions to remit the salary deferrals from employee paychecks into the plan accounts. The HR personnel responsible, if they decide that they're not going to deposit the deferrals into the plan accounts and then take the money and take off with it and do something with it, like go to Vegas, you know, then it leaves the employees without their money. So uh, really should be double checking to make sure that your deferrals and contributions have been deposited. Not only could this expose the plan to theft, but also to penalties in the event that contributions and deferrals are not timely deposited. And with the actual bond, you may not think that the assets being stolen in the plan are covered by the ERISA Fidelity Bond, but tender it anyway. There have been heated discussions between lawyers whether these types of assets should or should not be covered by the ERISA Fidelity Bond. And regardless of the answer, you should also tender it, which is basically just saying report the claim. And a big lesson to this actual suit that we had to pay out on, the insured on the claim decided he was going to take it easy on the bad actor because they worked at the company for a long time, and instead of tendering the claim to the bonding company, tried to work things out with the bad actor and carry the theft as a loan on the plan books for 2 years before tendering it to the bond company, and only tendered it because the employee stopped making the loan repayments. So, of course, this should never be done. If you were to do that, you're running the risk that the claim's not going to be covered. So you just basically have to tell your insurance company, if ever anything comes up, always report it, even if it's, a hypothetical and it could be happening. Just report it, just in case it does actually come to fruition.
No, it's a great lesson there, right? If something comes up, it's better to we've seen this before. Come clean early.
Yeah.
Oh, and we've got a couple others, Michael. Can you walk us through 3 and 4?
Sure. So in example 3, an employee of the plan sponsor obtains the coworker's confidential information at work and uses it to log into their plan accounts. And then they request distributions, appropriate the distribution checks, and convert them for their own use. So the lesson is protect your employees' personal data from both internal and external threats. The plan sponsor should take a look at their plan documents and see whether they have verification procedures for distributions, spousal consent, and required written authorizations. Another question would be who monitors online access to the plan accounts? Now, for the insurance lesson, if you flip the example and let's say that the bad actor doesn't work for the company, they steal a plan participant's identity, access their account, send a distribution check to a new address, and cash the check for themselves. There won't be any coverage under the ERISA Fidelity Bond. You need to know what's covered under your policy and what isn't. So just read the policy for the bond. So moving on to example number 4. In this example, a trustee takes money from the plan account purposely for the use of purchasing and investment for the plan. The purchase then gets recorded as an outgoing transfer of money as a plan receivable or investment. And it turns out that the money was not being used for a plan investment, but was being used to renovate the trustee's house. And another example would be if the money was being used to purchase an investment for the trustee's own personal benefit and not the plan's. And a practical lesson for this is that you as a plan sponsor should have enough independent service providers that you trust and that act as a check against the others and against yourselves. So in this example, the trustee directed the record keeper to record the outgoing money as a plan receivable or investment. A diligent record keeper may require more to verify a specific transaction and find a balance between familiarity and independence. The bonding lesson, of course, it's kind of the same thing going on. Tender notice to your bonding company as soon as you think that you may have a sustained loss. Your fidelity bond probably has a notice provision that requires notice of a claim within a specific period of time after learning of a loss. And then of the life lesson, this is kind of, try to avoid prison.
Right.
uh, on this claim, the plan sponsor didn't tender it within the bond's notice period, and the bonding company denied coverage, which was us. And then the plan sponsor sued the bonding company, which is us, and an attorney had to then take the thief's deposition in federal prison. So that wasn't fun at all for all parties. So that's the reasoning behind that.
Right. Life's always a
All right.
story, and I know
Yeah.
for what we do at Fiduciary Pension Partners, right, with the online, we talk to so many participants and say it's so important for you to register your account online, right? It's more secure when that is registered, and also, hey, you get a statement or you go online, check those transactions. If there's anything that doesn't look right, you want to certainly be able to report that to the record keeper, and as well as us. We work as the advocate for the participants in that case as well. And then with plan sponsor access, right? I know when we work with a plan sponsor, part of our due diligence is who needs access and what access do they need, so that hopefully an example that's preventing that example four of the wrong folks getting the wrong access at times. Let's turn our attention to fiduciary liability insurance, right? We talked about the bond. What is the fiduciary insurance? What is it? What is it not? So, Michael.
Of course. So fiduciary liability insurance protects the fiduciaries of the retirement plan. So this is anybody who has signing authority over the management of the plan assets. It covers for defense costs, fines, fees, and judgments over alleged fiduciary breaches. And these allegations could come from the plan participants, their beneficiaries, the Department of Labor, or the IRS. There's over 100 different fiduciary responsibilities that a plan sponsor does have. I'll run through a few of these that come up the most probably in the industry. Um, these allegations could be over improper amendments to plan documents, later misfilings of the Form 5500, later misdeposits of employee salary reduction contributions, participant loan failures, for example, if loans that exceed the maximum permitted dollar amount, failure to timely amend the plan to keep it updated with changes in the law, failure to follow plan terms, for example, an employee who meets the plan's eligibility requirements but is not allowed to participate, improper disclosures to plan participants, remiss investment advice, imprudent choice of outside service provider, and faulty advice of counsel. So usually uh, it's owners of the firm as a fiduciary. It could be your board members of a firm, whoever has that signing authority over the management of the plan assets. And you can be sure that obtaining this coverage through us, we differentiate, as I'm doing right now, greatly between the ERISA Fidelity Bond and fiduciary liability insurance. Often if you go through your agent or broker, they may not be educated on the rules and regulations of ERISA. Even if they're trying to write an ERISA Fidelity Bond for you, they might accidentally put a rider onto a crime policy that's written like it's fiduciary liability insurance, protecting the owners of the company instead of protecting who the risk of Fidelity Bond is meant to protect, and that's the plan participants. So while it's crucial to have the ERISA Fidelity Bond as is required by law, by the ERISA Act of 1974, to protect the participants, if you don't have fiduciary liability insurance as a plan sponsor, your personal assets are at risk. So, for example, the average defense cost for a really good ERISA attorney is about $365,000, with the average claim cost just under $1 million. That that's a pretty hefty amount if you're looking to pull out of pocket for that. So having this coverage for the amount of maybe like an hour or two of actual consultation with an ERISA attorney will definitely protect you and your home and your car and everything else
Right.
that you have. So yeah, that's the whole reasoning behind this insurance.
No, and that's so important to make sure who is defined as the fiduciary, and then to make sure that they are in fact covered under that policy. We're kind of running a little bit low on time, but we've got some great real life examples. One that I'm particularly interested in, which is this family cow fight.
Yeah, yeah. This is definitely an interesting one. So, a plan sponsor was a cattle business in the middle of the country, and he started the business, bought some cows, and sponsored an employee stock ownership plan so that he could use the shares of his own stock as collateral against a bank loan. Now, he brought his son into the family business, had the son roll his 401k into the ESOP, and use the 401k cash to run the business and pay the son back in stock. Then the son got tired of waking up at 6 a.m. to feed the cows and wanted to cash out and get his 401k money back. And the father said the cash was used for operating expenses. So then the son actually sued the father for fraud, breach of contract fraud, securities fraud. It was 12 different claims that had absolutely nothing to do with the pension plan. But one of them was breach of fiduciary duty for failing to diversify the holdings in the ESOP and alleging that the employer's stock was improperly valued, and the carrier had to defend the entire action. So the lesson behind this is sometimes bad things happen and litigation is expensive, particularly when you're defending claims and paying hourly fees for the privilege of doing so. Um, for the insurance lesson, the duty to defend is broader than the duty to indemnify. And in many states, if a complaint alleges one covered claim, the insurance carrier has an obligation to defend the whole action. So read your policy and have an idea of what's covered. You should know what's in your policy before a claim comes in. And if you're waiting for a claim to come in to first start reading the policy, then you're usually too late.
No, it's a great lesson there. And maybe if with example 3 and 4, we've got some questions coming in. I want to make sure we get to those. If
Oh,
you could
sure, sure.
maybe 30 seconds, kind of give us a quick overview of example 3 and 4 and what happened there.
Sure. Honestly, so for example, 3, it's a plan sponsor had a participant whose identity was stolen, and the thief was ultimately able to gain access to the plan participant's account and request a distribution. So the plan sponsor had a protocol in place whereby the plan sponsor was responsible for obtaining spousal consent before approving a distribution from the plan. Now, this is more or less what we call social engineering in the industry, where somebody actually hacks in, requests a distribution, and then it goes to the different areas like your third party administrator, your investment house like John Hancock, and if they all don't catch that and ask for that spousal consent, then it ends up being and suddenly the money's actually stolen from that from the retirement plan. That money isn't covered through the ERISA Fidelity Bond. Usually that's covered on a crime policy, um, and it's not even covered through cyber liability insurance. So this actually heads into another slide we were on, but um, so it's important to note um, what is covered. Now, fiduciary liability insurance still actually partially responds to this whole act, and protecting your employees' personal data. ERISA hasn't like meaningfully addressed this yet, but states that um, uh, they're developing schemes to regulate data privacy. So you have a fiduciary obligation to protect your employees' data. Um, and in this claim, there's no allegation that the plan sponsor failed to protect employee data, but the identity theft had risen because the plan sponsor got hacked. Um, but fiduciary liability insurance does respond to this claim. So that's the piece. Sorry, I'm
No,
trying to go as fast as possible since we're running low on time.
no, this is great, and again, this is where we work with the participants and say, hey, make sure your beneficiary information is up to date. Everyone's got a marital status, right? And should that change, that's real important here. Maybe quickly on the cyber liability insurance, that's been whether you're in a retirement plan or some, financial services companies are certainly getting attacked around through cyber.
Sure, sure. So for cyber liability insurance, small business owners often don't find that they have the expenses to really put all of the protocols in place, or they're not really educated, or they may not have an IT team to actually help put all the protocols in place to defend against an attack. Now, the Department of Labor has actually gone on record now stating that cyber liability insurance not having that is a fiduciary breach. So that's yet another thing you have to have in place to protect not only your company information but your client's information. And Colonial's cyber insurance is a services-based solution to manage the data breach successfully. So these services include a dedicated team of cyber breach professionals to assist you as a plan sponsor at every stage of the incident and investigation and breach response. And these professionals coordinate with carefully vetted forensics experts and specialized lawyers to help plan sponsors establish what's been compromised, assess plan sponsor responsibility, and notify those individuals affected. And in addition, these services will also coordinate creditor identity monitoring and public relations advice to help plan sponsors safeguard its reputation. So, of course, Colonial Cyber Insurance also indemnifies and defends plan sponsors from covered lawsuits or regulatory actions, the risk of which may be reduced by a well-coordinated breach response, but can never be completely eliminated. So ongoing governance and evaluation of record keepers can help protect data, but the only way to fully protect against a potential cyber attack is by obtaining cyber liability insurance.
No, no doubt. And every day we read about something that where somebody's getting hacked, attacked, or whatnot. So kind of what's mission critical here for folks from the bonding as well as the liability and fiduciary insurance. Michael, if you could, sum it up in 30 seconds. What's most important for plan sponsors here?
Sure. Just remember the differences between the ERISA Fidelity Bond and fiduciary liability insurance. Realize that um, the Department of Labor requires the ERISA Fidelity Bond. It's by law. You have to have that. You don't want to fall into an audit over this or any kind of citations. And that's what the Department of Labor is concerned about, is your participants. But you should also be concerned about your own liability and your own personal assets. And that's where fiduciary liability insurance comes in. Uh, Pair that with the cyber liability insurance. The good thing about Colonial is we actually offer the ERISA Fidelity Bond and fiduciary liability insurance in a package where we give you $50,000 of free cyber liability insurance. So we understand that it's important, especially after the Department of Labor came out with that statement about it being a fiduciary responsibility. So we're offering it free in the package, so you get all the protection all the way around, full circle.
That's great. And before we convene, we have gotten some great questions in from our audience. But in the interest of time, one that came in that is particularly interesting. What's the right amount of the bond and insurance? Does a $5 million plan need to have the same amount of coverage or bonding as, say, a $500 million plan? Is there some rule of thumb around the bond amount or the coverage amount?
Oh, sure. For defined contribution plans and defined benefit plans outside of ESOPs or like multiple employer, like actually pooled employer plans, the maximum bond amount for the Department of Labor is a $500,000 bond based on $5 million in assets. So that's for qualified assets, of course, stocks, bonds, mutual funds. But you can have $10 million in assets in a normal qualified plan, and you only need a $500,000 bond. That's the max that they require, and that's what you're putting on the 5,500 when it comes up in July. But for ESOP plans and for pooled employer plans, it changed a bit. For that, it's $1 million based on 10 million in assets for just those plans at this point.
And thank you for that. And for those other questions, we'll be getting back to the individuals that sent them. Well, Michael, it's been a great session. I know we're up against time. Real good information. I kind of think between the bonding and the fiduciary insurance, it's kind of those elements of the retirement plan space that is sometimes forgotten. But as you pointed out, it's real important to have the right bond and having the right coverage. To our audience, thank you so much for the questions. Thank you for taking time out of your day. I know we've all got busy schedules, so we hope you have found this informative. We will be sending out a four question survey to those that have attended. Get your feedback on this session. Obviously, we like to host other informative sessions, and your feedback as to what you liked, what you didn't like about this is so important. But with that, thank you for joining us. If you have any questions about what we've covered, our information is up on the screen. Both ours at Fiduciary Pension Partners, as well as Michael's information. Thank you for all joining us, and have a wonderful rest of your day. Take care.